On March 26, 2021, a single phone call from Credit Suisse to Archegos Capital Management triggered what would become one of the largest margin calls in financial history. What made the Archegos incident particularly alarming was not its size, but how quickly it unfolded, and how it revealed the interconnected web of leverage that had been quietly building across Wall Street. The family office had used total return swaps and equity derivatives to build massive concentrated positions in stocks like ViacomCBS and Discovery, all while remaining largely invisible to regulators, and even to some of the banks financing these positions. When these stocks began declining in March 2021, the margin calls came fast and unforgiving. This pattern of hidden leverage and sudden collapse is not new to financial markets. In 1998, long-term capital management's near failure required a Federal Reserve coordinated bailout when the hedge fund, $125 billion in assets, leveraged to over $1 trillion in positions, threatened to destabilize global markets. The fund had employed sophisticated mathematical models and had Nobel Prize-winning economists on its board. Yet it collapsed within months when Russian debt defaults triggered massive losses across its supposedly uncorrelated positions. The common thread connecting these events is the gradual accumulation of leverage during periods of market stability, followed by rapid deleveraging when conditions shift. Today, according to data from the Federal Reserve, margin debt at broker-dealers reached $935 billion in 2021, more than double the peak level seen before the 2008 financial crisis. But this figure captures only a fraction of the total leverage in the system. The real exposure lies in the vast over-the-counter derivatives markets, repurchase agreements, and complex financial instruments that allow institutions to amplify their bets far beyond what traditional margin lending would permit. The Bank for International Settlements reported that global OTC derivatives markets had notional amounts outstanding of $610 trillion as of December 2022. While the gross market value of these positions was significantly lower at $18.3 trillion, the sheer scale demonstrates how deeply interconnected global financial institutions have become. A relatively small movement in underlying assets can trigger massive margin calls when positions are leveraged 10, 20, or even 50 times their initial capital. Federal Reserve data shows that the securities lending market, where institutions borrow stocks and bonds for short selling or other strategies, reached $2.8 trillion in total loans outstanding by 2022. The repo market, where banks and dealers finance their trading positions through short-term borrowing against securities collateral, processes over $4 trillion in daily transactions. These markets operate smoothly during normal times, but they can seize up rapidly when participants lose confidence or when asset values decline sharply. The current environment presents particular risks because multiple factors that historically triggered major margin calls are converging simultaneously. Interest rates have risen from near zero to over 5% in less than 2 years, the fastest tightening cycle since the early 1980s. This rate environment increases borrowing costs for leveraged positions, while simultaneously reducing the value of long-duration assets that serve as collateral for many trades. What makes today's situation potentially more dangerous than previous crises is the sheer scale of the financial system and the concentration of risk among a relatively small number of institutions. The 5 largest U.S. banks now hold assets equivalent to approximately 40% of the country's gross domestic product, compared to 17% in 1995. These same institutions are the primary counterparties for the vast majority of derivatives transactions and serve as the crucial intermediaries in repo and securities lending markets. This concentration means that a significant stress event at one major institution can quickly spread throughout the entire system, as we witnessed during the 2008 financial crisis, when the failure of Lehman Brothers nearly brought down the global banking system. The difference today is that the total amount of leverage and interconnectedness has grown substantially, while many of the regulatory safeguards implemented after 2008 have been gradually weakened or circumvented through new financial instruments and structures. How did we arrive at this point? The answer lies in a series of policy decisions and market developments that seemed reasonable and beneficial at the time they were implemented. The foundation for today's leverage crisis was laid not through reckless speculation, but through a series of deliberate policy decisions designed to stabilize markets and promote economic growth. Following the 2008 financial crisis, the Federal Reserve implemented quantitative easing programs that ultimately injected over $3.5 trillion into the banking system between 2009 and 2014. This unprecedented monetary stimulus was intended to restore confidence and encourage lending, but it also created an environment where borrowing money became cheaper than it had ever been in modern financial history. The federal funds rate remained at effectively zero from December 2008 to December 2015, and then stayed below 2.5% until March 2022. During this 14-year period of ultra-low interest rates, financial institutions had powerful incentives to increase leverage to generate the returns their investors demanded. A hedge fund that might have been satisfied with 8% annual returns in a normal interest rate environment suddenly needed to achieve 12% or 15% returns to justify its fees when risk-free Treasury bonds yielded nearly nothing. This dynamic created what Federal Reserve officials would later describe as a reach for yield phenomenon. Pension funds, insurance companies, and other institutional investors who relied on steady income from fixed income investments found themselves forced into riskier assets and strategies. The result was a massive expansion of credit across virtually every segment of the financial system. Data from the Federal Reserve shows that total credit market debt in the United States grew from $54 trillion in 2009 to over $95 trillion by 2023. But the composition of this debt is what makes it particularly dangerous. Unlike the mortgage-driven debt expansion that preceded the 2008 crisis, the current debt buildup is concentrated heavily in corporate bonds, leveraged loans, and complex financial instruments that are designed specifically to amplify returns through borrowed money. The leveraged loan market, which barely existed before the 1990s, reached $1.6 trillion in outstanding debt by 2023, according to the Loan Syndications and Trading Association. These loans are typically made to companies that already carry significant debt burdens, and they often feature variable interest rates that adjust upward when the Federal Reserve raises rates. More importantly, roughly 80% of leveraged loans are now packaged into collateralized loan obligations, or CLOs, which allow investors to buy slices of diversified loan portfolios with varying levels of risk and return. The CLO market itself exemplifies how financial innovation can create new sources of systemic risk while appearing to reduce individual risks. By 2023, there were over $950 billion in CLO securities outstanding, compared to just $200 billion in 2008. These instruments allow banks to move risky loans off their balance sheets while still collecting fees for managing the portfolios. Investors, meanwhile, can choose tranches that offer steady income with supposedly low default risk. However, the rating agencies that evaluate CLO tranches use models that assume loan defaults will be uncorrelated across different industries and regions. When economic stress occurs simultaneously across multiple sectors, as it did during the COVID-19 pandemic, these correlations can increase dramatically. The result is that supposedly safe AOEA-rated CLO tranches can experience unexpected losses, while lower-rated tranches can become virtually worthless. The repo market provides another example of how gradual changes can create systemic vulnerabilities. Following the 2008 crisis, new regulations required banks to hold more capital and maintain higher liquidity ratios. In response, many banks shifted their trading activities to repo transactions, which allow them to borrow against securities collateral for periods ranging from overnight to several months. This appeared to reduce risk because the loans are collateralized, but it created new dependencies on short-term funding markets. Federal Reserve data shows that primary dealer repo transactions averaged over $3 trillion per day in 2023, up from roughly $2 trillion in 2010. The majority of this activity occurs in overnight markets, meaning that trillions of dollars in positions must be refinanced every single day. When repo markets become stressed, as they did briefly in September 2019, interest rates can spike from 2% to over 10% within hours, forcing institutions to either post additional collateral or liquidate positions immediately. The derivatives markets tell a similar story of gradual expansion, creating concentrated risks. The notional value of interest rate swaps held by U.S. commercial banks reached $170 trillion by 2023, according to the Office of the Comptroller of the Currency. These instruments allow banks and other institutions to hedge interest rate risks or speculate on future rate movements, but they also create vast webs of interconnected obligations. Just 5 U.S. banks hold over 85% of all derivatives contracts in the banking system, with JP Chase alone holding $54 trillion in notional derivatives exposure as of 2023. While these banks argue that their net exposures are much smaller because many positions offset each other, this concentration means that operational problems or credit concerns at any of these institutions could disrupt derivatives markets globally. The growth of exchange-traded funds provides yet another layer of potential instability. Total ETF assets under management grew from $1.3 trillion in 2010 to over $7 trillion by 2023. Many of these funds use derivatives and securities lending to amplify returns or provide inverse exposure to market movements. When investors rush to redeem ETF shares during market stress, fund managers may be forced to sell underlying securities rapidly, potentially amplifying price declines. Perhaps most concerning is the growth of private credit markets, which have expanded dramatically as banks face increased regulatory oversight of their lending activities. Private credit funds, which lend directly to companies without going through traditional banking channels, managed over $1.4 trillion in assets by 2023, compared to just $200 billion in 2010. These funds often use leverage ratios of 2 to 1 or higher, and they typically invest in floating rate loans that become more expensive for borrowers when interest rates rise. The common thread connecting all of these developments is that they were responses to previous crises and regulatory changes, not the result of reckless speculation. Banks moved into repo markets to comply with capital requirements. Investors moved into leveraged loans and high-yield bonds because traditional fixed-income investments no longer provided adequate returns. Regulators encouraged the growth of CLO markets because they appeared to distribute credit risks more widely. Each individual decision appeared rational and beneficial at the time it was made. But collectively, these changes have created a financial system where enormous amounts of leverage are embedded throughout multiple interconnected markets, all of which depend on the continued availability of cheap short-term funding and stable asset prices. The mechanics of a large-scale margin call are deceptively simple, but their consequences compound exponentially as they spread through interconnected financial markets. To understand how a $1.5 trillion margin call could unfold, we must first examine the precise sequence of events that transforms routine market volatility into systemic crisis. The process begins not with dramatic market crashes, but with small changes in asset correlations that gradually stress the mathematical models underlying modern portfolio management. Every leveraged position in the financial system exists because sophisticated risk management models convinced both borrowers and lenders that the potential losses were manageable and predictable. These models rely on historical data about how different assets move relative to each other over time. A hedge fund might borrow money to buy technology stocks while simultaneously shorting treasury bonds, confident that these positions will offset each other during most market conditions. A pension fund might use derivatives to amplify its exposure to real estate investment trusts while hedging currency risks in international markets. The critical vulnerability emerges when multiple asset classes that normally move independently begin moving in the same direction simultaneously. This phenomenon, known as correlation breakdown, has preceded every major financial crisis of the past century. During the week of October 19, 1987, correlations between previously unrelated stock sectors spiked to over 0.8, meaning they moved together 80% of the time instead of their historical average of 20-30%. The result was a 22% single-day decline in the Dow Jones Industrial Average, the largest in modern market history. Federal Reserve analysis of the 2008 financial crisis revealed that correlations between mortgage-backed securities, corporate bonds, commodities, and equities reached levels that their pricing models had assigned less than a 0.1% probability of occurring. When correlations spike across multiple asset classes, diversified portfolios that appeared safe suddenly generate losses simultaneously across all positions. Margin calls begin when these losses exceed the collateral that borrowers have posted with their lenders. The Securities and Exchange Commission's analysis of recent market stress events shows that modern margin call mechanics unfold in three distinct phases. The initial phase involves what regulators call targeted deleveraging, where individual institutions face margin calls on specific positions, but can meet these demands by posting additional collateral or closing positions in orderly fashion. This phase can last for days or weeks without creating broader market disruption. The second phase begins when multiple institutions face margin calls simultaneously, creating what the Federal Reserve terms liquidity spirals. And during this phase, institutions that might normally provide liquidity to stressed markets instead become forced sellers themselves. The Bank for International Settlements documented this phenomenon during the March 2020 COVID-19 market disruption, when typically stable government bond markets experienced unprecedented volatility as leveraged investors were forced to sell high-quality securities to meet margin calls and other positions. Data from that period shows that daily trading volumes in U.S. Treasury markets reached $1.1 trillion on March 9, 2020, compared to typical volumes of $150-200 billion. Despite this massive volume, bid-ask spreads widened dramatically, and many institutional investors reported difficulty executing large transactions quickly. The Federal Reserve ultimately intervened with unlimited quantitative easing programs, but not before many leveraged positions were liquidated at severe losses. The third phase occurs when forced selling becomes self-reinforcing across multiple asset classes and geographic regions. Academic research by economists at the International Monetary Fund has identified this as the point where localized margin calls transform into systemic events that threaten the stability of the entire financial system. Historical analysis shows that once this phase begins, it typically accelerates rapidly because financial institutions lose confidence in each other's ability to honor contractual obligations. The collapse of long-term capital management in 1998 provides a detailed case study of how quickly the third phase can develop. LTCM's initial losses in August 1998 were manageable, representing less than 10% of the fund's capital. However, as news of the losses spread, other market participants began avoiding trades that might benefit LTCM, effectively cutting off the fund's ability to reduce its positions gradually. Within 6 weeks, LTCM faced margin calls exceeding its entire capital base, forcing its creditors to choose between massive losses or a coordinated bailout. Federal Reserve transcripts from that period, released years later, reveal that officials were primarily concerned about the operational challenges of unwinding LTCM's positions rather than the direct financial losses. The fund held over $1 trillion in derivatives contracts with virtually every major bank and investment firm on Wall Street. Bankruptcy would have triggered simultaneous defaults on thousands of individual contracts, creating legal and operational chaos that could have paralyzed trading in multiple markets for weeks. Today's financial system faces similar operational risks, but on a much larger scale. The 5 largest U.S. banks now process over 80% of all derivatives transactions in the country, according to data from the Office of the Comptroller of the Currency. A single operational failure at one of these institutions could disrupt settlements across multiple asset classes and geographic regions. Moreover, the increasing reliance on algorithmic trading means that margin calls can be transmitted across markets in minutes rather than hours or days. High-frequency trading firms and algorithmic systems now account for over 70% of daily equity trading volume, according to data from financial research firm Tab Group. These systems are programmed to reduce positions rapidly when predefined risk thresholds are breached. During periods of high volatility, this can create feedback loops where algorithmic selling triggers margin calls at other institutions, which in turn generate more algorithmic selling. The flash crash of May 6, 2010 demonstrated how quickly these feedback loops can develop. Within a 36-minute period, the Dow Jones Industrial Average fell nearly 1,000 points before recovering most of the decline. SEC investigation revealed that the crash was triggered by a single large sell order that interacted poorly with algorithmic trading systems, creating a cascade of automated responses that temporarily eliminated liquidity in multiple markets. Currency markets present additional complications for global margin calls because many leveraged positions involve borrowing in one currency to invest in assets denominated in another currency. The Bank for International Settlements estimates that foreign exchange derivatives with notional amounts exceeding $95 trillion were outstanding as of 2022. When currencies move sharply against leveraged positions, margin calls can be generated not just by asset price movements, but by changes in exchange rates that affect the value of both the underlying investments and the borrowed funds used to finance them. The Asian financial crisis of 1997 illustrated how currency-related margin calls can spread rapidly across international markets. Many Asian corporations and financial institutions had borrowed U.S. dollars to finance investments in local currency assets, assuming that exchange rates would remain relatively stable. When the Thai baht collapsed in July 1997, it triggered margin calls that forced widespread selling of Asian assets, which in turn put pressure on other regional currencies, and it created additional margin calls. Federal Reserve analysis of that crisis found that the total amount of leverage in Asian markets was significantly smaller than current levels in U.S. and European markets. Yet the crisis required coordinated intervention by multiple central banks and the International Monetary Fund to prevent a complete collapse of the international financial system. The key lesson is that the interconnected nature of modern financial markets means that large-scale margin calls can quickly overwhelm the capacity of individual institutions or even national governments to respond effectively. The current financial landscape presents a convergence of vulnerabilities that historical analysis suggests could trigger the largest margin call event in modern history. Unlike previous crises that emerged from single sectors or specific instruments, today's risks span multiple interconnected markets simultaneously, creating what Federal Reserve researchers have termed polycrises, conditions where seemingly unrelated stress points can amplify each other with devastating effect. The most immediate trigger lies in the corporate bond market, where $11.2 trillion in debt now trades at yields that remain historically low despite recent Federal Reserve rate increases. Analysis by the Bank for International Settlements shows that over 40% of investment-grade corporate bonds were issued when interest rates were below 2%, meaning companies will face dramatically higher refinancing costs as these bonds mature over the next 5 years. Standard & Poor's estimates that $1.4 trillion in corporate debt will require refinancing by 2026, with another $2.1 trillion due by 2028. The leverage embedded in this refinancing wave becomes apparent when examining how these bonds were purchased and held. Mutual funds and exchange-traded funds focused on corporate bonds now manage over $4.8 trillion in assets, compared to $1.2 trillion in 2008. Many of these funds use derivatives and leverage to amplify returns, while others have attracted investment from institutional investors who themselves borrowed money to increase their allocations to fixed income strategies. When corporate bonds decline in value, these leveraged investors face margin calls not just on their direct bond holdings, but on the derivatives positions they use to hedge interest rate risks. The notional value of interest rate swaps held by U.S. institutions reached $170 trillion by 2023, with the majority of these positions designed to profit from or protect against declining interest rates. As rates continue rising, many of these swaps generate losses that must be collateralized with cash or additional securities. The real estate sector presents another critical stress point, though its risks are distributed differently than they were before the 2008 crisis. Commercial real estate values have declined by an average of 15% since their 2021 peaks, according to data from Green Street Advisors, but the leverage supporting these markets has shifted from traditional bank loans to complex securities and private credit arrangements. Commercial mortgage-backed securities outstanding totaled $550 billion as of 2023, while private real estate funds managed an additional $1.3 trillion in assets. Regional banks, which hold approximately 70% of all commercial real estate loans according to Federal Reserve data, face particular stress because many of these loans were made at peak property values with variable interest rates. As rates have increased, both the servicing costs for existing loans and the likelihood of defaults have risen substantially. The Federal Deposit Insurance Corporation reported that charge-offs on commercial real estate loans increased by 180% between 2022 and 2023, reaching levels not seen since the immediate aftermath of the 2008 crisis. However, the most dangerous element of current market structure may be the growth of private credit markets, which have expanded to fill the lending gap left by more heavily regulated banks. Private credit funds managed $1.4 trillion in assets by 2023, according to Preqin data, with many of these funds using leverage ratios of 2-to-1 or higher to amplify returns. Unlike bank loans, which are subject to extensive regulatory oversight, private credit arrangements often lack standardized reporting requirements or stress testing protocols. The borrowers in private credit markets tend to be companies that cannot access traditional bank financing or public bond markets, often because they already carry substantial debt burdens or operate in declining industries. Interest rates on these loans typically float with benchmark rates, meaning that the recent Federal Reserve tightening cycle has dramatically increased borrowing costs for companies that were already financially stretched. Moody's Analytics estimates that default rates on leveraged loans could reach 4 to 6% by 2025 if economic conditions deteriorate moderately, compared to current levels below 2%. When private credit defaults begin accelerating, the losses flow back to the pension funds, insurance companies, and sovereign wealth funds that invested in these strategies, seeking higher yields than traditional fixed income markets could provide. Many of these institutional investors use borrowed money to increase their allocations to private credit, creating leverage on leverage structures that can generate massive losses when underlying loan portfolios deteriorate. The derivatives markets that connect all of these sectors have grown to unprecedented size and complexity since the 2008 crisis, despite regulatory efforts to increase transparency and reduce systemic risk. The notional value of over-the-counter derivatives reached $610 trillion globally by 2023, according to the Bank for International Settlements, with roughly 40% of these contracts involving interest rate risks that have moved dramatically against many participants over the past 2 years. Central clearing, which was mandated for many derivatives transactions after 2008, was designed to reduce counterparty risks by ensuring that losses were absorbed by central clearinghouses rather than transmitted directly between trading partners. However, this system concentrates risk at a small number of clearinghouses that must collect massive amounts of margin from their members during periods of high volatility. The Chicago Mercantile Exchange, which clears trillions of dollars in derivatives transactions, increased initial margin requirements by over 40% during the March 2020 market stress, forcing participants to post additional collateral worth tens of billions of dollars within days. International interconnections add another layer of complexity because many U.S. institutions have significant exposures to European and Asian markets that face their own leverage-related vulnerabilities. The European Central Bank's analysis shows that Eurozone banks hold over $2.8 trillion in leveraged loan exposures, while Japanese institutional investors have increased their holdings of foreign bonds and leveraged instruments to offset the negative yields available in domestic markets. Currency hedging costs for these international positions have increased substantially as interest rate differentials between countries have widened. Many institutional investors who borrowed Japanese yen to purchase higher-yielding dollar-denominated assets now face margin calls both on their underlying positions and on the currency swaps they use to hedge exchange rate risks. The Bank of Japan's periodic interventions to support the yen have created additional volatility that stress tests these hedging arrangements. Perhaps most concerning is the concentration of market-making activities among a small number of institutions that facilitate trading across multiple asset classes. The top 5 dealer banks now provide liquidity for over 70% of corporate bond trading, 80% of derivatives transactions, and 60% to foreign exchange activity, according to data compiled by the Federal Reserve. During periods of stress, these same institutions often reduce their market-making activities precisely when liquidity is most needed, accelerating price declines and margin calls. The technological infrastructure supporting modern financial markets creates additional vulnerabilities that did not exist during previous crises. High-frequency trading algorithms and electronic market-making systems are programmed to reduce positions rapidly when volatility exceeds predetermined thresholds. During the brief Treasury market disruption in October 2014, these systems effectively stopped providing liquidity simultaneously, causing yields on 10-year Treasury notes to swing by over 30 basis points in minutes, despite the absence of any fundamental economic news. Operational dependencies on cloud computing services and electronic communication networks mean that technical failures at major technology providers can disrupt trading and settlements across multiple markets simultaneously. The complexity of modern financial instruments also means that accurately valuing positions during periods of stress requires sophisticated models and real-time data that may not be available when systems are under pressure. Historical analysis suggests that when multiple stress points emerge simultaneously across different sectors and geographic regions, the resulting margin calls tend to overwhelm the capacity of individual institutions and markets to absorb losses gradually. The key difference between manageable market corrections and systemic crises appears to be the speed with which leverage unwinds rather than the total amount of leverage in the system. When deleveraging occurs gradually over months or years, markets can adjust and institutions can rebuild capital buffers. When it occurs over days or weeks, the system's shock absorbers become overwhelmed. The $1.5 trillion estimate for potential margin call exposures reflects not a prediction of certain catastrophe, but an acknowledgement that the current financial system contains sufficient leverage and interconnection to generate losses of that magnitude if multiple stress points activate simultaneously. Whether such an event occurs depends largely on factors that remain unpredictable: the timing and severity of economic shocks, the effectiveness of policy responses, and the confidence that market participants maintain in each other, its ability to honor their obligations during periods of extreme stress. What history teaches us is that major financial crises rarely announce themselves in advance, but they invariably expose vulnerabilities that seemed manageable during normal market conditions. The question facing financial markets today is not whether the system contains enough leverage to generate a systemic crisis, but whether the institutions and mechanisms designed to contain such crises can function effectively when tested by conditions that exceed their historical experience.